Hello, everyone, and welcome to another live event, live set of the series of workshops coming to you from the Helios team as part of the EVMxIdeathon hackathon event. So to those who have missed the previous live ceremonies, we've actually had a couple now. If you head over to the Helios, well, if you're watching this on Twitter, you can go over to the Helios YouTube channel, and you can find that if you follow our Helios description. It should show up there. And on the YouTube channel, we've got a playlist for the EVMxIdeathon, and that includes the opening ceremony, which gives you a rundown of what this entire hackathon/ideathon event is about. We've also had a design thinking workshop, which gives you the do's and don'ts and some trusty tips if you're coming up with a brand new idea, and even just for doing a regular EVM GameFi submission. So there's 2 tracks to this event. That workshop is very useful to give you some do's and don'ts on coming up with a solid idea and how you should move forward. Then we had a pitch deck workshop with Gabriel Shaw from the Helios team. And that was basically as part of the EVM track. One of the requirements is a pitch deck. So you're going to pitch this idea like you were to a VC, basically. And so that was a good discussion. If you're curious on how to build a pitch deck, what should go into a pitch deck, again, some more do's and don'ts. That was a great workshop for that. Then we had the Antelope overview. So this is, of course, a partnership between the the ENF, the EOS Network Foundation, and Helios. And so the Antelope blockchain stack is the EOS Network is the first of the 4 chains in the Antelope coalition to migrate to the Antelope tech stack. And so we had Eric from the ENF do a great workshop there about how Antelope works and what you should consider as you're building your idea. Well, first of all, if you're building an actual developed project, then yes, you need to know this. But even as an idea, if you just have an idea you're trying to build, you want to, or suggest, you want to at least know what should you or shouldn't you include on a blockchain? What aspects should be off-chain? What aspects should be on-chain? What do you need to consider with the permission systems on Antelope? And so that was a really good workshop. And now today we've got tokenomics and gamification. So here we're going to talk about just that, tokenomics and how to gamify your idea, if your idea even should or shouldn't have tokens. Tokens aren't for everything. And then next week, we'll have community development and marketing. So that'll be the last in the series of live workshop events. Certainly encourage you to attend these live if you'd like. We will take questions in the YouTube channel. So if you've got any questions for the live presenter, that's the place to do it, and we'll bring those up. And you get the most out of these events where it's more like an actual lecture type of thing where you're sitting in the auditorium and you can raise your hand and ask some questions. So we would certainly recommend that. So far for the overall event, we have 409 participants. So that's quite a good start. There's still 19 days left to submit your project, whether it's for so there's 2 tracks in total, $125,000 in prizes. 50,000 is going to be going to the Trust EVM GameFi track, and 75,000 is going to the Ideathon track, which includes GameFi, DeFi, Social Good, Gov3, and Web3. So for the Ideathon, this is really a low barrier to entry. You don't need to develop. There's no coding required. You just need to have an idea. However, you need to present that idea in a pitch deck, a pitch deck. And so when you do that, ideally, you're also doing a little recording of yourself delivering that pitch, something like you'd see on, say, Shark's Tank, but a digital version of you delivering a pitch. And what will happen is on November 14th, there will be a final live event where not only will we reveal the top winners from the Trust EVM GameFi, which is an actual code required, you're deploying onto the Trust EVM testnet, and there'll be a demo for the top 3 prizes for that on the 14th of November. But in addition, for each of the 5 categories for the Ideathon, the top 3 as selected in advance from the judging, they'll come and pitch live. So it'll be very much a nerve-wracking moment for some of those teams. Hopefully we have a lot of turnout and participation to watch that, a lot of chat engagement. And Darren actually will be one of, so for today, we've got Darren Swords doing the tokenomics and gamification. He is from the Origin.1 team and the UX Network, who is part of the Antelope Coalition. And so he's going to be doing the tokenomics gamification and will also be one of our judges. So with no further ado, let's bring in Darren to the stream. Darren, welcome. Thank you for being here.
Hey, Chris.
It's bright and early for those of us in North America. This is 8 a.m. Eastern and 5 a.m. for those on the East Coast, sorry, West Coast. So maybe not as much engagement today, but for Europe and our far east folks, this is a great time for them. So Darren's in Europe, so this is a good one. He's nice and chipper. So with that, I think I've covered all the basics here. I'll hand it over to you, Darren, and you can take it away. If there's any questions, again, folks, just type that into the chat. We will bring that over to Darren, and I'm sure to interrupt from time to time as well to ask Darren some fun questions. So with that, I'll let you take it away.
Yeah, okay. Well, this is a bit of a dry subject, so I apologize. It's quite, if it is early for you in the morning, but it is critical, more and more so as crypto markets have kind of matured. Most people have realized that tokenomics to date has been problematic, and there is a very rational approach, and I use that word quite a lot, so I apologize if I'm going to repeat myself throughout this presentation, but some things are just very, very critical to how you build these systems. And just generally, just to give you some context, so Origin is a business, just to give you some background, Origin is a business that we have an infrastructure arm, which everyone's kind of quite familiar with, where we kind of build our own protocols, we build networks, we're building the IBC on Antelope, and we build a whole vertical stack of kind of of stuff that leverages blockchain, because we have a kind of very kind of long-term view of how blockchain actually delivers economic value to kind of real world stuff. And as well as technology, you can't get there unless the token models actually work. And, not just in the short term, but for a very long time, because ultimately, and especially in decentralized protocols, you don't really want to go changing them. You want them to run and to kind of live forever, and to fairly reflect the economic value of whatever your project or dApp or application, protocol, whatever it might be. That's the economic health of that, and the unit of account for that system needs to be rational and fair. Otherwise, your project will die. And the reality is, and what people have realized now more than ever, is that you can have a good project, you can have the best IP, you can have the greatest tech, you've written all of these kind of wonderful algorithms to solve all of these things, the best consensus mechanism. But if your token model isn't built around that and doesn't fairly reflect that, then it won't survive, because the next guy will come and copy your system and build something and make his token model rational, and you'll be priced out of the game. So there's quite a lot of stuff that goes into this, and I've kind of broken it down a little bit to sort of go through the process of how to think about if you're running a project, how to build a token, do you need a token, and what it kind of all entails. And there, as I say in the presentation, this is kind of like, this is a general approach and a general general methodology, and there isn't, there's various many ways to kind of slice this cake kind of thing, but let's just take a look through the presentation, and then we can build the picture from there. So the first thing to kind of like get to grips with is that tokens are a new asset class. Like and I don't think many people have realized this. And what I mean by a new asset class is they don't look like traditional. They don't look like traditional instruments. And this is kind of a very kind of human error, like, if you like. Whenever anybody looks at something, or anyone looks at something new, what they try to do subconsciously is make it look like something they know. So if you're an investor in stocks, you'll look at a cryptocurrency and say, how do I make it look like a stock? Does it pay dividends? Who owns it? Who controls? How does it make profits? And if I'm a bond investor, I'm looking at it like, where's my security? Where's my assets? How do I get interest? And then, of course, I think the worst thing that ever happened to crypto was calling it a cryptocurrency, because for me, it's fundamentally not a currency. not in the traditional sense, and again, in the as I say here, tokens are often misunderstood, not because people are kind of stupid, but it's because they come from this area of finance and that's what they understand. But it's not correct, because if you look at a stock as a claim on profits, and a bond as a claim on assets, and currency as a claim on kind of GDP, sovereign credit. A token is a claim on utility. And that's a kind of pretty interesting, quite important statement to understand. Because once you understand that, you're able to actually define a much more logical capital structure for your token and usage for your token. And that also leads to a much clearer fundamental valuation of your token, based around your model and your economic projections.
Darren, this is you said something that I think to some they'd be like, what is he saying? Bitcoin is a currency. How dare he say such blaspheme? So this is really interesting. So when you say a token, the utility, can the utility be to act as a currency or store? I'm just trying to think of the Bitcoin example, just because it really is.
Let's take Bitcoin, because it's a good example. So Bitcoin for me is a bit like gold. I'm not in the kind of like, and again, I don't want to get into the digital gold argument. That's kind of like, it's a gray area. But if you ask anyone what the value of gold is, no one can tell you an answer. I mean, they'll tell you something about, it's an inflation hedge. It's negatively correlated to the dollar. It's this, that, and the other. It's got history of money. But no one can actually say, fundamentally, I can break it down into these kind of like interesting financial metrics that gives it a dollar value. And so I'll come back to that in a second. So if you think about Bitcoin, so what's the value of Bitcoin? Like, what's its intrinsic value? Its intrinsic value is the ability for me to give you, Chris, some value. I can send you some money, and no one, in theory, can interrupt that. So that the utility value of Bitcoin is just that. It's just, what would I pay to send you money that no bank, no regulator, that no government can stop? And so if you kind of invert the problem, so you're not saying, there should be a fee associated with Bitcoin and it should be this much dollars. What you're saying is, what's that dollar benefit to me being able to do that? And to different people, it's different things. I mean, obviously, if you're if you're acting illegally, it's obviously worth a lot more. But if you simply want, a confidential transaction that's kind of, financially beneficial to two parties, and you want to use an immutable, tamper-proof system, then there is a value. So if you think about that, you could actually say you could build an economic projection around how much value in perpetuity would ever be transferred using this system. And then if I can make assumptions about what the cost of that should be, I can solve for a dollar fundamental value of the Bitcoin system. So by defining this utility value of Bitcoin, I'm actually able to take a very traditional financial approach to measuring a fair value. And it's never going to be exact fair value because of the probability and the distribution around all of these kind of, how many people would ever use it, why would they use it, what would a fair price be. But you have a framework, and that framework doesn't exist currently when people just say it's a store of value, it's got 21 million, it can only ever be capped, and stuff like that. Those are consequences, things like, Bitcoin's going to do something because we've seen all these on-chain or off-chain wallets and doing this and doing that. It's like, those are consequences of markets. TA is a consequence of markets. It's not fundamentals. So defining fundamentals in Bitcoin, I mean, look, it's it's kind of a bit of a non-starter, because you'll be the same reason as gold. People will argue all day long about what it's worth. But if you bring that utility value back to your own project and your own business model, it's really important for you as the kind of project sponsor to say, I understand what my token's claim on utility is, because then I can value it based on any set of assumptions I wish to make. And I sorry, just to go back, because so when I come back to gold, if you think about it, what's the value of gold? The value of gold is I can give you some gold and no one's going to get in the way of that transaction. And that's why, you know, in certain countries, people will keep gold under the bed in case they need to raise an army tomorrow. It's like, yeah, like the banking system's shut, take some gold. So anyway, we digress.
Great response. Thank you. I appreciate that. Was an excellent answer. And I want to bring up one from Hokentech, who is an alumni of Helios. And he just wants to confirm here, when you're talking about tokens, do you mean any token? So also non-fungible tokens when you're speaking to tokens?
I include non-fungible tokens in the discussion. I mean, it has different characteristics, but ultimately, so an NFT for me, so NFTs are kind of fascinating because they have a third. So later on in the presentation, you'll see I define 2 utility functions. It's a bit tongue in cheek, but let's assume you have your primary utility function, which is what's this claim on utility? So this claim on utility. So let's take an NFT, for example. An NFT could be a claim on, you know, the right to access higher levels in a game or something like that. But it also has something else. Well, normally has something else, which is this the artistic value, which I think is kind of interesting, because now you have a kind of a 2 portfolio asset where you have you know, something that could be quite beautiful, you know, to the eye, that's a collector's item, that's a rare, you know, a rare whatever. You know, imagine you're playing a game and you have like the rarest, you know, level 14 sword. You know, it's beautiful, it looks great, you've got these bragging rights, but also it's really good because you're a good player in the game. You're playing this game and you can, like, you know, win lots of prizes. Well, at some point you've got to make a decision about the capital value of that item, is how much utility you're getting from using it in the game, and actually how much you know, is it worth in terms of just standalone tangible artistic value. So NFTs have a different kind of economic picture, but ultimately the same, you know, the same kind of approach is kind of required to certainly to model them.
Yep. Thank you. No more questions. You may continue on your presentation. Thank you, Darren.
I mean, just a good example of that is like CryptoPunks, for example, and I guess Bored Apes. You know, I prefer CryptoPunks, just my preference. But CryptoPunks, you know, a very cool piece of artwork, kind of represented for me, like all art needs to have context. For me, the context was generational wealth change. Okay, crypto generational wealth change. You know, probably at some point forward will be looked back as a historic point in time, and that's what that art for me represents. Consequently, you also have the commercial rights now as the holder of CryptoPunks. So you've got actually an economic utility inside it, which I think why these are now being slowly bought up by big brands, but also this unique artistic value, which is very hard to replicate. I mean, you know, that's kind of the beauty of, that's the kind of, you know, back to the fundamentals of art. Anyway, I'm not an NFT expert, but and I just highlight in the presentation that, you know, okay, if Bitcoin is this P2P value transfer, and therefore you could say the same thing about, you know, smart contract platforms, which, okay, what's the utility value of a smart contract platform? Okay, well, it's the ability of the smart contract to effectively, you know, take away a load of expense from a non-smart contract platform. So that's your kind of, that's your dollar claim on utility, is it's kind of this benefit that you get by using a smart contract rather than using, for example, you know, traditional paper and kind of, you know, email documents. And again, like, I just invent a token XYZ, but it's, you know, if I know I have the right to buy a load of stuff at a perpetual 20% discount, which we've kind of seen in sort of classical discount tokens, well, it's very easy to say, well, if the target market is, X billion dollars, then therefore my token economy must represent 20% of that. I mean, these are kind of really kind of logical, easy assumptions to make, but only if you approach it this way. And I guess just to step sideways slightly, like we've been, I was saying to you, Chris, earlier, we've been building token models for probably 3 to 4 years now. And for 90% of that time, no one cared about our token models because they didn't look like anything else in DeFi or crypto, because we weren't building basically from the kind of consumer level. We weren't building saying, hey, I've got a model and it needs to give me 1,000% APY and it needs to stake here, and I can't allow any liquidity and I must suck up this and I'm going to give all these VCs all these benefits. We just never went down that route because none of it made any sense to us. So for us, it was all about your token model. It's all about this long-term utility. You need to manage this short-term stuff, but you'll be out of business if you don't manage the long-term stuff. And it's only in the last 6 months since events occurred around token models, in the kind of big collapse that we probably don't need to mention, where people said, oh yeah, actually these guys have been making sense. We just didn't realize. And now, again, I was saying earlier, we have huge demand for these kind of very rational models built like this from real world businesses, not from kind of like really kind of crypto native people, but from real world businesses wanting to understand how they can expand into like Web 3 or Web 2.5, whatever they want to call it, but leverage tokens, but with a rational experience, a rational economic experience. So let's just move on. Otherwise, I'll just be rambling on all day. And again, well, I'm just reiterating the point here, but for me, it's all about rational capital. A token is capital. You have to maintain the rationality of that token throughout your whole system. And that all comes back to understanding your utility value. Like, you always want to maintain this proportionality between, here's my token, here's my utility value. I got more tokens, I get more utility. I get less tokens, I get less utility. I mean, it's pretty basic stuff, but you see it. You don't see that in a lot of token models because they come very convoluted with, passive staking and kind of, governance used as a kind of, abused, I guess is the word, which allocates excess capital to non-contributors, which then starts to blow up the system. There's also quite a few other problems in token models, which I'll come on to a bit later, around things like adding too much complexity or overstepping mathematically is one way to think about it. And so, just to be clear, the models that we build, the models that we recommend, and again, there isn't one size fits all, as I come on to later, but generally our stuff is very much, it's dynamic, it's algorithmic. There's no guy sitting there every month typing in a number saying, oh, I think staking should be 10% this month, or I think I want to create a 400% APR incentive for people who kind of vote for the DAO. Or there's nothing like that. At its core, you can put that on top if you like. You do what you want in your actual application, but in the kind of smart contract framework of a token model, these are kind of mathematical, algorithmic, simple systems, actually, linear generally, with no human overlay, and just kind of, for any number of reasons, you don't want to be sitting there every month kind of looking backwards and manipulating your token model. I mean, it just brings in lots and lots of issues, legal issues, and just a lot of aggravation. And actually having to solve for those numbers is you're always on the back foot. So set your model up, set your parameters, understand what your model does, just let it run. And if you got it right in terms of, if it works, if it complements your business model, then your token model will just, it won't need the work that you might otherwise think it does. So again, one size doesn't fit all. There are so many different versions of what blockchain is in terms of where you sit in the stack. You know, are you kind of decentralized? Are you centralized? Are you kind of, you know, are you is it just a simple, I'm a business, I want to leverage blockchain, but I'm not pretending I'm going to be some kind of like community driven, you know, DAO driven enterprise. I'm doing all the work. It's my product. It's my IP. I'll have a token, but ultimately, you know, it's going to pay me dividends and my investors. So we have to look a lot at the business model to start with, and the business model drives your utility value as well. So a lot of projects come to us and they actually have a great business, but they've tried to design a token, but in the main, it kind of generally looks like an equity, or it's a fee paying instrument. It's like, oh, I'd like to like issue my products on a blockchain and I want to use it. And the token pays fees. And if you pay in fees, you get discounts. And that doesn't actually work. I mean, I can tell you now, but creating a token actually is a bad word, but currency in your system. It won't, it doesn't work. It's not logical. You'll never be able to create a rational economic system around that. You're always going to be beholden to volatility in price movements and solving backwards for dollar prices, and it just goes nowhere. So a lot of the time we spend. Sorry, Chris. Yeah.
Yeah, I was just going to say. So I mean, you're getting to this idea that sometimes a token is not a great idea. So I think that's often something I heard a long time ago or a few years ago when I was coming up with an idea.
It hurts.
Right.
It hurts to say it because it's not my business to say it. But I'd say 9 times out of 10, people turn up with a project and they've kind of had a go at doing the model themselves, or they've retained someone to do it for them. And the hardest job is to unpick it and say, this isn't going to work. You don't need a token here. You don't. If your business is selling widgets, right, and your costs are in dollars, and you want to put it on a chain, why do you need a token? Like, just charge people in stable coins. I mean, you get some back office efficiency, some settlement efficiencies, you know, invoice discounting, whatever it might be. Great, use a blockchain, but you don't need your own currency, because ultimately, what's the point? Like, okay, I've got to buy your widgets. I've got $10. I want the widget. I got to swap $10 into a token. I got to give you the token. You're going to sell the token back to someone, the same guy who sold the token to start with, to get dollars to put into your bank to pay for the cost of the widgets. So it doesn't make any sense. Those models
it's a lot of complexity addition, which I suppose it really, and that's likely not what the business is really about. It's just adding complexity to an underlying business. Yeah. Well, thank you for that.
You're adding friction and you're adding volatility. So it's like you're destroying your own business model. So what we really tend to look at is, the first thing we look at with a token model is the business model. So, like, what is it you're doing with the business, and what is it you want to achieve with this token? Because every business has, different. Every industry, every asset class, every kind of like type of business, they all have something they want that is a structural lever to driving their profitability. So the trick is, okay, you've got this business model, and here's what you need to do to make your business profitable. How can we look at that in a token or a blockchain context and see if it will work? And like you say, sometimes there isn't the need for a token. And certainly if the business is very centralized, then there's no real point, because for me, a token is actually does something else. So for me, a token is, the more decentralized a system is, the more requirement there is for a token, because decentralized systems, by definition, do not have a central planning authority. There's no board of directors. There's no one that says, guys, I think we need to put the prices up. It's too cheap. Like, we're selling widgets too cheap. Like, we're eating into our margins. So you have to have a unit of account that reflects your system health, your system economics, that can do all that for you. And that's what the token does. In reality, the token is this kind of balancing instrument that allows you, as a decentralized, technically isolated entity with no decision making, to actually interact with the next system in a fair and equitable manner, which means, what does that really mean? It means your token has to be super efficient. So the value transfer and the attribution of value, say, between two systems that need to talk to each other to achieve, a product delivery, is super efficient and super rational. So if your tokens are now irrational and become badly priced, this whole structure fails. And if that structure fails, that's Web3, right? This is kind of the concept behind Web3. So getting this token right, again, is kind of like it's kind of critical to the survival of Web3. So one size doesn't fit all. Business model, okay, as we've discussed. Equity structure, I think I actually break these down a little bit. Yeah, so so business model, as I said, like what does your business do? What do you want to achieve with this business? And I guess, if you're a gambling business, you want to get as many users as you can. If you're a gaming business, it's monthly average users, whatever it might be. So if it's a user acquisition model, there's one way of building a token model. If it's a way of kind of either capturing fee revenue or enhancing fee revenue, ideally is what you want, but it's a kind of different model. And it could just be, I just want to use a blockchain because I'm outsourcing my capital expenditure. I'm putting my back office, if you like, on a public platform, and it's understanding these sweet spots in the business model that is, and that's how you kind of like get this bottom up. I call it this bottom up build of a token model, and I say bottom up as opposed to the kind of top down approach, which is kind of endorsed, is more popular in crypto, which is like, it is the one size fits all. It's like you got to have, you got to have VCs, you got to stake here, you got to like have a liquidity pools, you got to do this, and all of that. The more you do of that kind of like crunching, it's kind of brute force fitting a model on top of your business. The more you do of that, the more kind of damage you're actually doing in the long run, because you haven't considered these kind of the features that are unique to your project and to your business. And ultimately, this is how you've got to explain it to investors. It isn't, a matter of convincing, a kind of like, a Discord channel. It's a matter of convincing, people with money that this is how you're going to make money. This is how your business is going to make money. And this is how you're going to leverage blockchain. Because a lot of the time, businesses, investors will say, well, why do you need a token? Why is this? I don't get it. So you have to demonstrate, or you should have to demonstrate, that your token actually is complementary to your equity position, to your profitability. And quite simply, if you do this, you define it this way, then it's very easy to say, oh, listen, I'm building this business. If I built this business at scale and in 5 years' time, I actually I would be spending $1 billion on a back office. But actually, I don't have to spend that $1 billion now because I'm using, EOS or whatever. Well, then the fair value of your capital, of your token, is $1 billion. I mean, it's not rocket science. Some of this stuff, it's relatively simple. And then to kind of expand a little bit here, the token must be complementary to equity, as I've said. And then where you really need to think about is, okay, what is the right allocation for for your team? There's kind of various kind of ways to calculate that and to think about that. You can take parallels from kind of early mining in back in kind of way back, what allocation actually ended up with core developers. And again, I'm not a big proponent of this, but more centralized systems will put platform fees and royalties that go come directly out of the network and go to like to a company, to a corporate. That's kind of more of a centralized system. Personally, I prefer, and this is just my preference, I prefer to see much more alignment between teams and the kind of ecosystem, and kind of like sharing in the kind of the overall economics. Keeps everyone much more interested. And one thing I touch on here is like the bifurcation of kind of like technology and commerce. And what I mean by that is you can actually have kind of like a two-stage, and again, it depends on your business, but a lot of people come with a business that they want to earn money. Like I've got a product, I want to, I think I can launch a token, but actually I've got this product here that I've got shareholders for. I need to pay shareholders dividends. How do I do that? And the one way to do it is just saying, well, you build an open network that anyone can use to do the business that you want to do. And you're obviously a founding developer of this kind of this lower level network that you are then going to put your business on top of and leverage. And that gives you 2 bites of the cherry, because now you've built your own network to support your business. It doesn't mean other people can't come in and put their business on that platform as well, but that kind of benefits you anyway, because you're sitting both sides of the table. So just some ideas there. And again, we've touched on this already, but a lot of the projects I see coming through now are, they're just not Web3. They're Web2 and a bit. They want to get to Web3 at some point. They don't know how to get there. So, and the reality is, as we've kind of seen empirically, immediate decentralization is, on the whole, a bad move, because you end up with, it just becomes chaotic. Decisions don't get made. It's a wonderful philosophy, but in practice, it's very, very difficult to keep a handle on and keep control of. And I get asked quite a bit to help out, look at restructuring of certain platforms that have fallen by the wayside in recent times, and I just won't go near it, because I know I can get nothing done, because all of the power, if you like, has been disseminated to in this democratic kind of like set of token holders, who no decision will get made, and certainly no rational decision will get made for many, many years to come. And so you have to consider, when you're building these models, is you're not going to be decentralized day one, and nor should you be, but you should look ultimately for a migration plan, through your business model to get to that point. And as long as you present that as a kind of, if you want to be decentralized, of course, but if you want to get there, and I think, my opinion, again, like I said earlier, is if you don't really want to be decentralized, actually the value of your token will end up being a lot lower. So if you're going down the decentralization route, you have a migration plan, but also you don't have to be, you could, obviously we're going to say you're going to launch on a blockchain. So assume that's decentralized. So you've got 3 levels of decentralization, blockchain, the application, and governance. Most projects will be obviously blockchain. The application will be a decentralized application, but at the outset, they're going to be running the show. And it's, probably 2 to 3 years before they get to a point where, if ever, that they're going to release this to some form of community governance. And so, so why is all this important? So the thing that obviously we've all seen has been problematic is you do have 2 basically potentially misaligned interested parties in your token. You have people that want to use the product. Okay, that's cool. They're going to hold the tokens, and they're going to deploy the utility at some point when it comes online. And then you've got the numbers go up group, and that's okay. People invest to make money, but they have their own utility function, which is, if they don't make money, they're going to move on. And so in all of this model, you have to plan for how you handle your product launch. Where is the timing of your product launch? When does your token actually come to market? And how do you treat, token holder number 2? Is how do you manage them, and how do you, allow them to have an economic interest in your system, but not to act against your interests? And that's a kind of, that's not an exact science, I'll be honest with you. This is where things can get a bit tricky. So let's
Darren, before we go to the next slide here, we just had a a question from Hoken Tech, just about Capex. He just wondered if you could give some examples of companies that use Capex, and I guess there's a longer version of the question here. Basically, some companies focus on Capex, capital expenditure, and he doesn't quite understand what that is, and so it's a bit off topic, sort of, but maybe you can tie that into tokenomics and how some tokens, create a token that they can use for Capex, perhaps, or see if you want to dig into that a bit.
It's more about like the general use of a blockchain. So if you think about just think about an insurance company is a good example. The insurance company will, you buy your insurance policy. They then go to a reinsurer and enter into a contract to reinsure it. The reinsurer might then split that out between a couple of other reinsurers. So you end up with a kind of like a web of contracts sitting inside an insurance company with, a team of 20 people, bunch of infrastructure, bunch of checks and balances, audits. So that's your capital expenditure to run this insurance company is kind of, that's part of it, right? Well, now imagine, and let's say that costs you, I don't know, whatever it might be, 100 million a year. So let's just say now is like, well, actually, if I put this on a blockchain, in theory, I don't need all these kind of audit tools, and I don't need, every party is one smart contract, and every party is now kind of, has their kind of rules and about when they get paid and how they get paid and what risk they take. And so now I've managed to get rid of that 100 million a year cost, and I've stuck it onto a public blockchain. And there's a cost to that, which is, the cost of resources. So now I'm going to, so now my cost of resources now replaces my capital expenditure bill for my insurance back office, my insurance settlement system. So so capital expenditure is a big kind of like very simple utility case for public blockchains, and that's kind of like so it may just be that's all you want to do is kind of like use a public blockchain to kind of like leverage your own cost base, or actually smash your own cost base. So if you go around, if you had to talk to a CTO of a company, and you could demonstrate that a blockchain increased their ROI just by smashing their costs, forget about the revenue expansion to the other side of the equation, but just by reducing the costs, well, then all of the money flows up to equity, up to their shareholder returns. So so in general terms, that's how I kind of like look at Capex as a kind of like as a utility of blockchains. Okay, just
Yeah, no, that's good. Thank you very much. Yeah, no, there was no follow up there.
So pauses. Did I?
Yeah, no, sorry. I just don't want to sit here and people look at my head while you're talking, so I remove myself.
No worries.
But we did get a here we go. So Hoken Tech replies, so simplifying company processes with blockchain to reduce cost.
Yeah.
Is that a fair summation?
The first thing I thought when I saw smart contract platforms back when was actually insurance companies, and because I'd had dealings with them, and the kind of like complex web and generally kind of like slightly 90s 80s approach to managing to risk and contracts. And the first thing I thought of was that is $1 trillion industry, and blockchain just focusing on that industry could strip out 10 to 20% of the cost base, and you can do the numbers. That was what attracted me first to, I think, to smart contract platforms. So okay, rational modeling is key. We can talk a lot about rational, but what does it all mean? So there's kind of like three elements, I guess. There's kind of like the macro element, which is this kind of like your externalities. It's like, okay, people want your product, and you need to supply them with your product. So how does that work? What are the kind of like what are the physical laws of the universe that need to apply in your system. Then you have like the microeconomy, which is much more, okay, this is great, but internally, how do we allocate rewards to people? Like, how do we incentivize people to do things and to kind of and to behave for the good of the system? And then there's a slightly different topic, but it's quite critical, which is kind of issuance of tokens, and how token holder number 2 doesn't kill you. So and just generally, just to say, and I get this quite a lot, is if it's a shitty business, it's a shitty business. Like there is no token model that is going to stop that. If a business is going to zero, the token's going to zero. The trick is, of course, what we're really trying to do is say, if your business is successful, then it should feed into the token. The token should be completely aligned with the kind of with the economic interests of a business, and that's why the model needs to be right. So there's obvious mistakes people do make, or things to consider with this kind of macro position, and I think that one of the big mistakes that people make is to there was always and there is, and it kind of has sense in Web3, fat protocol thesis, which is all about the layer 1 has all the value. Like in Web 2, like the layer 1 has no value. In Web 3, and we attribute the value to the layer 1. And personally, I don't quite believe that. I think it's much more. I think layer 1s are are price takers rather than price makers, and I think that's the problem people have with this, because people want to try and set prices. If you take Ethereum as an example, Ethereum is a value trap. Bless them, but the minute anyone tries to, the minute usage increases, you have this kind of convex pricing mechanism for what I call local pricing. Local pricing is pricing in Ethereum. So not only do you have this kind of like pricing going like this in Ethereum, but of course more people using Ethereum is more people buying Ethereum so the dollar price is also going up. So now you've got like a win-win if you're a miner or whatever, they have a validator now on Ethereum, but ultimately it ruins the utility value. And I take the opposite view, actually. So I think that, well, firstly, that's kind of, it's incorrect to do that. You shouldn't have this kind of like convex payment system for product, because not only the main reason it's unpredictable. So if I want to buy your product, I need to know what the price is. I can understand it shifts with market supply and demand, but it should be a rational shift. It shouldn't be, I'm the layer 1, I tell you the price and you pay it come what may, because ultimately no one's going to adopt that. So don't like, I come on to this a bit later, but don't try and set prices. Allow price discovery in your model, and we come on to that a little bit. But also, don't make complex convex payment systems inside your model either. Again, it's all for people to use your system, use your product. Generally, it's all about ease of use. The minute you make it difficult, the minute you make it unpredictable, you actually kill your usage. And if you follow the logic through, if you kill your usage, and what we're saying the whole time here is your utility is driving your token value. If you kill your utility, you're killing your own token. So, okay, short term, no one really understands crypto. It's kind of cool to kind of like get massive percentage points fees on all of these new products. But in the long run, it's not sustainable, because price is competition, technology adoption. You'll be too expensive for the market, and you won't be able to change it. Whereas if you adopt a dynamic system that enables what I call price discovery, so your token just responds to supply and demand, and that's done rationally, then you'll be able to charge, you know, big fees when you can, but you'll also naturally allow your margins to compress as the market matures, and that's important because you want to stay in business. So so when I say appropriate friction, there needs to be some friction, because and that's a technical issue to do with well, the third point, which is if someone can use your system for free, they'll just use it for free. Like, you've always got to go to the edge case. So if someone can use your system for free, they'll use it for free, and ultimately that's not good. Like, you're going to get, especially if you're on a blockchain, because, you know, cost of resources go up, and we've seen this a few times when people don't make a point of friction for entry to the system, it brings about anarchy. And there's another implication, which is anyone that's coding around your system will develop weaker code because they know that they don't need to worry about resource costs, for example, because you're allowing anyone to use the system at any time. Now, that doesn't mean, when I say there's a point of friction, the point of friction I normally like is through staking rather than gas fees. And that's in the second point there. 90% of the time, it's better to have a staking system to access product than it is to pay transaction fees. And that stems from user friction. If I stake a token to access, it feels a lot better as a user than if I have to actually pay fees every time I do it. So that's a kind of psychological thing. But actually, mathematically, the two actually equate. So you can pay lots of gas fees, or you can stake a token. One is a direct cost, and one is what we call a cost of capital. Now, if you use the staking, and it's a kind of implied cost of capital because no one sets it, actually that gives you price discovery. So you can't use staking all the time because, you know, if I want to buy a newspaper, you know, I'm not going to stake some tokens to buy a newspaper. It's an instantaneous transaction. But I say 9 times out of 10, actually, staking models are a lot better. And all of this is designed to allow your system to find an equilibrium state between supply, demand. You know, demand increases, you know, price goes this way, demand decreases, price goes that way. And that's how a rational token model should work. It shouldn't be distorted by, you know, slashing, complex curves, because the minute you bring in a complex curve, it's really hard to then value this present value of utility, because you've got this kind of like bizarre curvature that mathematically is just difficult to model. Okay, so here and a safe thing here: keep the math simple. Now, there's you know, in crypto over the last 3 years, we can talk about it in a second, but firstly, and it's back to the Ethereum example. If you have like a linear system, the linear system will capture the external complexity. And the external complexity is, of course, things like network effects. You know, network effects are exponential. So you don't need to build an exponential curve into your token model. All you need is something very simple and very linear, and you will allow the external complexity, like a network effect, will drive the value of your token. So actually, you achieve the same thing by just keeping it very, very simple. And again, like, you know, corollary is you want predictable utility costs. You don't set them in dollars. That's not a cool thing. But you want a user to know that, you know, the analogy would be if I rent an office and, you know, it's $10,000 a month, and, you know, I go in the next month and it's $100,000 because a load of guys moved in upstairs. You know, that's just not cool. And that's not the way the world works. So predictable utility costs, keep the complexity to a minimum. And then there's a third element, which we see a lot in crypto, which is a little bit more nefarious, where someone will write a big white paper, they'll produce extreme amount of mathematical proofs, typically pretty, as I've seen, pretty poor maths, actually pretty they'll I saw one paper, I won't say what it was, but it spent 2 pages defining how to calculate formally just the average of 6 numbers. So what happens is people go, oh God, I don't need to read this white paper. These guys know all about what they're doing. Look at the maths they've written out. And then they go and invest in the token. So, I mean, you're welcome to do as many mathematical proofs as you like. But at some point, with the world maturing, investors are going to look at that. And if you've written shitty maths, you're going to get penalized for it. So, avoid the temptation, like in marketing, to produce lots of these mathematical proofs. Keep it simple. It's not required. And these systems don't need complex maths. And actually, a blockchain, from a resource perspective as well, you don't want to load your smart contracts up with complex calculations. And like I said, you'll be grateful. People will be grateful for the simplicity. So just taking away from the macro, just like you've got this micro economy. What's the micro economy? The micro economy is kind of where you have people contributing to your economy. Like, what are they doing? They're kind of like, oracles are posting prices, or whatever. Block producers are validating blocks, whatever it might be, depending on the system. But actually, so the first mistake people make is they create staking pools, and it's designed to trap liquidity. In reality, and they'll say in the white paper, oh, we don't want people selling the tokens, we want them to lock their tokens up. But actually, it's a kind of zero-sum game, because actually what you're really doing is you're kind of subsidizing people's tokens. You give someone a big APY for doing nothing. What you're actually doing is you're saying, oh, the real price is a lot lower because I'm subsidizing you for holding these tokens. So actually, the read-through is quite negative. What staking should be doing is making token holders into service providers. And it varies from system to system, but let's say you can relate the fees for your service can have a relationship with staking. So the more people that stake, maybe the lower fees go, something like that. Now, and that if you just think about the logic, okay, why would that be? Because what you would then find is, if a portion of those fees were being recycled to staked token holders would find the optimal capital allocation that they would be comfortable with in the yield that they're getting in fees from the system. So actually, by virtue of just saying, I'm going to allow the system capital to set the fee rates, they're doing the job for you. They're actually solving. You never need to say, oh, the cost of these goods today is this, because the staking is doing it for you. It's actually solving for a kind of equilibrium point where the return on capital for your system and your business risk is acceptable. So by doing that, you've actually made your staking community your service providers. You're paying them for setting the price for your goods, so you don't have to do the work yourself. So that's the way to think about staking. It's a service provision to the system. It could be for other reasons. It could be whatever. It just depends on the system that you're in. And again, avoid the kind of APY liquidity trap. Don't say anyone who locks their tokens up and by default isn't selling them on Binance is someone I want to reward, because in the long run that's a bad move. And I'm a big believer in, if you allow people liquidity, you allow people liquidity. Like, markets are markets; they kind of should find their own price. So again, that's your consideration when you issue tokens as well. And the last thing is, and I touched on it earlier, don't randomly think about slashing tokens, because that introduces a whole different world of complexity. When you have, like, let's imagine you've got a system where some people can stake to provide a service and some people don't stake because they want liquidity. Okay, that's fine. And the people that are staking are getting paid system tokens from some arbitrary inflation rate, let's say. What does that really mean? It means that the guys that aren't staking are underperforming. They're getting implicitly slashed, if you like, because they're not providing the service. But that's okay, because the service that's being provided is actually beneficial to the whole system. So as a token holder, I'm happy to not receive that reward because I don't want to provide the service, but someone else is doing it, so they should get paid and I benefit from it. So in a way, I'm kind of paying them out of my network ownership to do the service I don't want to do, and that benefits me. So that's fine. So the minute you start slashing people as well, you enter into this kind of like 1 + x over 1 - x problem, which gives you this kind of like, you know, nasty curves. And then you're into a kind of another world of pain, which is, how much do I slash? Who decides who gets slashed? Why is it it's just, you're adding a whole layer of complexity you don't need to add. Now, some systems do require it. There's quite a lot of theory around whether or not you need a kind of a stick to make people stake correctly for certain things, but it's very specific to that particular system. And then finally, just thinking about rewards and incentives in the system. And this is part, I tend to think of it not as gamification, but actually as a kind of a logical incentive mechanism, is that everyone's incentive rewards are relative. You know, like what you give one guy and what you give another guy should be relative to their economic contribution. So what is the value of the services that are being provided? But actually, and another mistake people make is they say, well, I'm going to give 20% to oracles and 20% to block producers, and these numbers don't mean anything. They might be good numbers. We might think, oh yeah, you know, these guys deserve 20%, but actually, you're much better off, again, allowing the system to algorithmically solve from the system state to determine what those numbers are. So, and that kind of probably links you back to staking. We tend to like link a lot of things back to the staking ratios. You know, in a single, how many people are staking might determine the skew of incentives between oracles and block producers, or between liquidity pools and a treasury function. It just depends. But again, avoid fixed numbers, avoid arbitrary numbers. Think about relative returns for contribution provided. And if you keep thinking in that way, you're always solving backwards to this value attribution of your utility value, which is your kind of like core tenet for your whole system. And so in all of this, like the real trick is that you have a lot, because it's decentralized in theory, you have a lot of people acting independently with their capital, and you want to give them rational choices with their capital. And if you do that, and you incentivize it with regard to your utility value, and with regard to this value attribution, relative value attribution throughout the system, based on what the system's telling you, you're always going to get, you know, the outcome that is best for the individual will always be best for the system itself. So you avoid, you know, the classic prisoner's dilemma, which, you know, as you know, the choices you make are not in the best interest, they're in your own interest. Right. So, and that's a complicated subject that can go on for days. So again, just a quick summary: equilibrium supply and demand, efficient allocations, allow your system to discover price, not price setting. Just a couple of like fun things, like Occam's razor is basically like, make it as simple as possible. Don't add other parameters that you don't need to add. You know, kind of, you know, trim as best you can. I mean, this system start off, when you first start a model, they start off as very complex, and then the trick actually is to distill it to its simplest form. So actually, what ends up coming out is actually really simple, and in a way, people might not understand even what's going on, but because it is so simple, they can't see the kind of origination of how these kind of formulae became like incredibly basic. And then the thing that obviously is more fun is, you know, Murphy's law. If anything is going to go wrong, it's all going to go wrong, and it's all going to go wrong when you just don't want it to. So, you know, the more complexity, you know, the more demand you have on smart contract resources, you know, the more edge cases you're probably going to find. And by keeping it simple, by keeping this kind of like logic in place, you actually end up avoiding a lot of these problems, because you have rationalized this. And I think one of the problems in decentralized protocols that I see is when you have multiple people developing the protocol. So it's kind of modular. So people will do the first bit, and another group will do the next bit. And the problem with that is this kind of portfolio addition doesn't have any benefits of kind of like of a correlation term, actually. So actually the complexity is far too big in a lot of current protocols, and actually that leads to a lot of the hacks that we're seeing at the moment. So then probably the most contentious subject, which no one likes to really discuss, and it's quite difficult as well because you end up managing investors, but is to do with issuance. Hold on 1 second. I think I've kind of, let me just go to this slide. So this is to do with kind of, token holder number 2, who's is the numbers go up guy. So all he wants to do, he wants to get in the private round. He wants to see your token, go up 10x, and he's kind of, his life is happy. It doesn't always work like that, and certainly not in these markets. But so the first thing that the biggest problem I see in a lot of these issuance structures is the alignment of investors. So it's fine to do different investor rounds. Okay, seed round at 5 cents, whatever it might be, 10 cents for the next guy. But it's when you start to give them different liquidity profiles, that is a problem. And it makes it very, very hard, just from a fundamental perspective, to actually value a token. And I'll give you an example, like an extreme example. If I can buy a token at 10 cents and I have immediate liquidity, or you can buy the same token at 1 cent, but you don't have liquidity for 10 years, who's got the better deal, right? So, in crypto, obviously, the 10-cent guy. And it's all to do with the volatility of these assets. So you could say, well, that's okay. I can take everyone's different liquidity, and I can discount them at different risky rates, and kind of try and work out what the present value of all these issuance or allocations are. But it's just a waste of time, because it just creates complexity. So the first thing to do is to say everyone has the same liquidity. Don't do all these kind of vesting cliffs. I don't even understand some of the terms people use. They don't make any sense. Avoid that, because it's every investor will tell you something different. Like they need this, they need that, and they need 10% liquidity up front. Yeah, this is really hard for projects, especially if you're not used to dealing with investors. But you have to say, no, everyone gets the same liquidity. We'll differentiate you on price. That's fine. The earlier you are in our investment structure, the cheaper the tokens. That's okay. But now you can compare apples with apples. A guy buying at 1 cent can be compared to a guy buying at 5 cents, because they have the same liquidity. And that's kind of critical, and for practical reasons as well. And you should have some logic to how you price your investment rounds, rather than kind of 1 cent, 2 cent, 5 cent, 10 cent. Again, I won't go into it now, but we developed some methods for understanding how much risk an investor took, depending how early they were in the investment phase. So you can actually solve, it might not be the right method, but as long as you've got a method for pricing investment rounds that has some rigor to it, people will understand that, and you can lean on that. If anyone questions why you're doing it, you have a reason for it. And in terms of the investor liquidity, what we would always look at is what we it's not exactly continuous, but continuous vesting. So a portion of their liquidity unlocks, in theory, every moment, but you can do it monthly or whatever. But the point is that they can all have continuous liquidity over a period of time, following some kind of growth curve that can be customized. So again, this kind of same rational pricing, rational allocation, kind of the same philosophy that we put in the whole model comes back here. And I think we wrote an article on this some months ago, which I've referenced here, but just to give you an example of how we would look at liquidity curves for investors, and then the risk pricing of investment rounds, and it's how far back you were from TGE, from the when you invested. Is how you calculate the discount that you get on the tokens. All Okay, so I'm just a bit conscious of time. And again, and then the token allocation, the kind of balance sheet of a project, it's important to kind of think about relative allocations. So we would always say, okay, if you look at, let's look at a team versus investors. What should the allocation to investors be versus the team? Well, broadly speaking, it should be about 50-50. Like that's a kind of like, well-trodden rule of thumb in traditional markets, actually. So, if there is a team that's running a business, the funding capital would take 50% and they would keep 50%. So in a token system, if the team is getting 20%, you'd allocate 20% of the tokens for investors. And again, with all these allocations, you should always be thinking relative, like everyone is relative to everyone else. There isn't kind of absolute numbers. And the biggest mistake I see in token models from an allocation perspective is with what's called advisors, which we happen to be advisors for various projects. So probably not doing myself a great service here, but we see advisors getting paid far too much for the services that they actually provide. So, we see advisors getting, up to like 5% of a token supply or something. Whereas, you've got a team getting 20% and an advisor getting 5%. And, the advisor's just putting his name on a bit of paper. You're probably not going to see him again after the first couple of months. And he's clipping 25% of what the team are getting. And so, again, some of that is, you need to manage who your advisors are, what their roles are, and they should be contracted properly with milestones, blah, 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 blah. But generally, I would say the advisor allocation is far too much. And there was a kind of bit of a gravy train for the last 2 or 3 years where people put their name on bits of paper and had no obligation to deliver anything, and were just renting their name for a kind of like a free option on these advisory tokens. And then the kind of issuance of Capex pools is quite difficult. And a lot of the time, so if you look at a tokenomics breakdown, you often see 20% for marketing, whatever it might be, 10% for partnerships. This actually like puts you in a bit of a box because you've no idea how much you're going to spend on marketing. You've no idea how much you're going to spend on partnerships. You haven't found those partners yet. So it's much better to just have a kind of like more of an honest approach and say, there is a Capex pool. This is a bunch of tokens. It will only be used for Capex. It's not a hidden stash of tokens that the team actually owns, because then it moves back into a kind of very kind of like centralized pool. So these should be kind of like treasury tokens, if you like. So which in theory, the treasury should be kind of owned by the existing token holders, if you kind of follow the logic through. So, and again, you're always allocating, like I say, it's relative, and it should be based on economic value added. If you're an investor, you're writing a check. That's your obvious economic value. But if it's a team, you're hanging around for a couple of years to actually deliver a product. And sorry, I did touch on liquidity earlier, but the kind of alignment between team and investors is the team allocation we always recommend is back-ended. So you allow investors liquidity first, and then you allow the team liquidity to kick in. So and then in terms of deriving issuance curves and things like that, I mean, these are kind of fairly kind of easy mathematics to do. What it's really about is it comes back to your business model. It's saying, when is my business going to reach an inflection point? When am I comfortable having, say, 50% of my tokens in existence? And really, you're going to solve backwards from your core business model to solve for this issuance line. It's very easy to do, and like normally, the sweet spot is about 2 to 3 years. But again, it's kind of like this is very business centric. Because you just don't know. And obviously, there's a couple of fairly well known techniques with like okay, you want to incentivize early adopters, but you don't want to flood the market with tokens. So again, balancing act, back in line with your business model. There's no exact science to it. There's no one size fits all. These are, these have to be customized parameters based around your own risk-based assessment of your business, its adoption curve, and where you want to be in 1 year, in 2 years, in 3 years time. And then just kind of the one consideration which I think gets a bit of bad press, which is like having a cap supply versus an infinite supply. And that takes you back to the kind of whole Bitcoin is great because there's only 21 million. And it's really kind of, again, it depends on your business. I'll give you an example. If it's a utility token for a game, and you have a capped supply, well, there's no way for new players to actually gain dominance in a system. So actually you want an infinite supply because you always want recent utility, if you like, to have the most impact on governance of a system. If you had a big early adoption curve, and as we kind of seen in some of these systems, and big chunks of tokens go into wallets that are not going to participate in the system in 5 years' time, they're just looking to hold and then sell. Well, it actually destroys the value of the whole project because it's trapped resources. It's not being deployed. Whereas in an infinite system, you always are able to shift the relative quantity of ownership between those who are active and those who are not. And it comes back to the same, you want to reward people who are contributing to your system, and people who are using the system should be rewarded and given more say in what happens, especially in gaming, for example, than those who aren't. And you can't achieve that in a capped system. So again, business model driven. So and then I just touch on governance because our model really is much more avoid human interaction. Don't take a cool bit of tech and then go back to a judge and jury system. There's no point. But governance, there are things that can't be decided in code. There are kind of more practical things at a kind of higher level. Again, we spoke about this earlier, the migration plan to full decentralization. That makes sense. But think about a meritocracy rather than a democracy when you're thinking about governance. Everyone isn't qualified to opine on everything. I mean, that's the big mistake I see in crypto. People should need to be qualified to opine on certain things, or earn the right to opine on certain things. And that's not to say not everyone has a voice. Hi, mate.
One question about issuance. Please talk about the initial amount of issuance in your view. Billions, millions, infinite.
So mathematically, it doesn't matter. Like you could have one token, you could have 1 trillion tokens. It's just like, for me, it's practical things. It's like, what does, psychologically, what do you want? It's psychological, it's optical. So if you, personally, I can't stand looking at those exchanges where you're looking at 24 decimal places to try and find what the price of something is. 0.000000124. It's like impossible to read. So if you start off with 1 trillion tokens and you're a small project, it's likely you're going to get into the decimal point problem. And you might even get a rounding error. So, which is a killer. So I would sort of solve backwards a little bit and say, what do I think what do I want my token to be worth? So, there's this whole problem on NASDAQ. Well, not problem, but psychologically, if something, and I don't know if it's still the case, but if something drops below $1, it creates other problems. I think they delist it anymore, but they do something with it. So psychologically, no one ever wanted their stock to drop below $1. So you'd obviously want to issue less shares to have you want to issue 10% of the shares to have a $10 share price rather than 100% to have a $1 share price. And we get some of that in crypto. So it's kind of like, where do you want it to be priced? With an approximation of what you think the value is. And, I'd say psychologically, people kind of want to see a token that starts off about, and this is just my preference, but, it starts off at 1 to 2 cents. You kind of feel like you're getting a bargain. And it grows and it grows, and it kind of feels like you've done really well if it gets to like up to $1 or something like that. So I'd solve backwards for that, really. I mean, I would say, just rule of thumb, between 100 million and $1 billion is the kind of, I mean, it's a big range, but it kind of depends on what you're doing as well. Sort of makes sense. But it is all because a lot of this stuff is actually, ultimately, remember that these systems won't be used by humans. They're going to be just, interlocking protocols that kind of deal with each other. So in the end, it doesn't really matter. But in the short term, I'd say psychologically, between 100 million and $1 billion, and just and then kind of to the point about, if you're going down the infinite issuance route, make some projections with your kind of inflation of emission inflation, and make sure you're not going to end up with a quadrillion tokens in 3 years' time, kind of thing. That's it's a bit finger in the air, it's a bit arbitrary, but that would be my advice.
Perfect. Yep. Thank you. And one thing on meritocracy here from the same Kuniter. Meritocracy has a lot to do with the initial token issuance. He has to do something with the token, of course, other than just pay for it.
Yeah, exactly. Like you always, I mean, again, it depends on the system, but like let's imagine you're in the user acquisition business. All you want is users signed up. Say you want KYC users, right? So KYC users bring you value as a business. If you have like, a KYC user is worth 10 times as much as a non-KYC user in say gambling systems or an exchange, a centralized exchange. So you would give tokens to people that signed up with KYC. They're making a capital contribution to your business by doing that. So you reward them with tokens. And again, like I said earlier, like people that contribute to the system, but definitively contribute, not, I mean, again, it's a bit arbitrary, but, I don't mean just like, send out Twitter feeds on your project. I mean, more kind of like active, like technical contribution. They're rewarded with tokens from an inflation allocation. Well, okay, they have earned those tokens. They haven't, this isn't like, so people that have, have delivered value have the say in what happens. But that is really critical. Like, it all does come back to issuance, and even just, like with investors, like with your team, like with advisors, you've got to be very, very cognizant of the power that you're giving to someone by handing out too many tokens, or too many tokens for no contribution. And that in the end, that can kill your system. So, but the democracy point is like, when I've seen a lot of these DAOs come about, and everyone has a say, everyone's got to be heard. It's kind of like I don't know. It doesn't work, and because there's no, they haven't earned their place. Now, I'm not saying this is not to say that we're going to some privileged system where unless you've got like a degree from Harvard or something, you can't opine on something like that. That's not what this is. But it's more about more low level demonstrating the right to govern, if you like, by simple actions, not through being complex, not through kind of like, scientific diatribe or anything like that, but more through, okay, I staked, I did this, I did that, I gave my KYC, I have a seat at the table. Someone else has a bigger seat at the table. But the kind of corollary of this is that it's also, so now I've got, let's say I've done all these things, I've earned these tokens, but I know my limitations. Like if someone's saying to me, oh, we're having a vote and we'd like to know, we'd like to change the consensus mechanism or whatever it is, I would be like, well, I'm not the guy to make that decision, but I'm happy to use my capital to appoint someone else who I know is an expert. And that's why the DPoS philosophy is much more interesting to me, which is where we say we are a democracy, like, and we've kind of earned the right to be here through the contributions we've made. but we aren't qualified in this particular matter, but we can appoint someone that is, and you can have a much fairer, for me, that's a much fairer system where we use our capital to vote in, in democratic fashion, experts in the field, or whatever it might be, that then delivers the value back to the system. So again, you're still maintaining capital proportionality with value that you can deliver back to the system. But again, I prefer governance at a higher level, and it has to be in place somewhere. Someone has to be doing something, but avoid it at the kind of like system level. So I'm just again, I've kind of rambled on a bit longer than I thought. So there's just a couple of quick summary slides here. So again, build this bottom up from your business model, a meritocracy, support it with capital rationality. Always think about, when you're building these models, always think about it from a kind of an arbitrage perspective. Are you allowing arbitrage? And arbitrage is good, by the way. Any system that enables people to deploy capital to capture an arbitrage gap will keep that system efficient. So arbitrage is good. Like, if your system is rational, arbitrage will exist, because if prices differ too far from kind of a fair value, then arbitrage will kick in, and that actually keeps your system stable. So people try and actually avoid it, but I kind of embrace it, and that gives you equilibrium. And again, it's Occam's razor: keep it simple, avoid slashing is my recommendation. Keep thinking about utility, and then just practical stuff. Get a legal opinion, get a tax opinion on the model. Just saves you a lot of aggravation in a few years' time. And then concentrate on price discovery. Don't be the guy setting the price. Allow your system to discover the price. And then, things not to do, don't give out 10,000% APY, because you don't want people to sell the token. Don't try and think you can control the token price, or, model dollar fees. It just doesn't work in the long run. Be rational with your capital allocations. Don't kind of give someone an advantage, especially early on. Don't allow yourself the kind of luxury of having to set system parameters every month. Manage your investors. You tell them what's what. Don't listen to some guy who's telling you he needs 10% liquidity and a 6-month lockup, rather than this kind of your nice continuous curve, because even though he might be able to give you $1 million, he's going to screw your business model long term. So, avoid all of that stuff. And then, kind of obvious, but the way you really manage these two investor groups, token holder 1 and token holder 2, is you don't launch a token without a product, because it's got nowhere to go. Now, it may not be in final form. That's okay. But the kiss of death, and we've seen it recently, because what's happened is a lot of VC investors have pressurized projects to go to market too early, because they kind of got their own problems. They need money. And so they want money out of these tokens. And projects are launching, but their tokens are failing because there is nowhere to go with the token. There is no utility and no sight of utility, because there is no product. So, make sure you have, basic MVP, basic product ready, something for people to do, so that there can be a change of ownership, because it's all about change of ownership. Your original investors aren't going to be long-term investors. I mean, they might tell you that, but that's the game, right? So the real trick is make sure that there is someone to buy the tokens from the guys that want out, because they can then use it in the system, and the price they're paying is below their theoretical utility value. And obvious, but just don't copy other models which are popular, especially if they don't make any sense to you, because that's a road to ruin. So I think that's pretty much it from me. I've probably gone on far too long. So Chris, over to you.
Well done. Okay. Well, Darren, this was a very comprehensive summary. This is you set the record for the longest, most detailed live stream, which is awesome. So, but you know what? The more information, the better. And I think folks will get a lot out of this. And that's the beauty of doing these live events. It's here. It's now on our YouTube channel for posterity, and this, I'm sure, will be of use to many projects well beyond the Ideathon. And so definitely appreciate your time and consideration and your knowledge. You bring a lot to this. So, and if folks want to get a hold of you, they can reach you. I think, and you did put Origin X.1, Origin 1, and then do you do Twitter and any of that? That's not really your jam, eh? Any other way to get you?
I don't personally. We have a Twitter account, like there's an Origin Twitter account. Yeah.
Well, and also, if anyone has any questions for Darren directly, come into the Discord. We've got that on the EOS Network Foundation Discord. There's a hackathon channel there, and just ping me, and I can bring Darren in any questions he's got. I can certainly relay those to you, Darren. Then any questions afterwards. Yeah. So, well done. Okay. Well, thank you, sir. Thank you, everyone, for participating.
Cheers, guys.
Okay, we'll talk again, and that is the end. Thanks, everybody.